Hey there everyone, how's it going? Welcome back to the channel. If you're new here, I'm Tom, and today we're diving deep into something that's on everyone's mind, the looming recession, how the Fed knows it's here, and what it means for your everyday life and your crypto investments. We're going to unpack everything from the Fed's moves to some significant signs in the economy, and most importantly, how all this could hit your wallet. So let's jump right in. Typically, recessions come after the Federal Reserve cuts interest rates. It's like a signal that things have already gone south, but this time, the Fed is doing something different. They're warning us ahead of time that rate cuts are on the horizon. Normally, they lower rates when the economy is in trouble, but this time, the trouble is already here, and the Fed is pretty much giving us a heads up that things are about to get worse. And if you're thinking this is just another warning, you might want to brace yourself, because those rate cuts could happen a lot faster than even Jerome Powell expects. Now, let's talk about interest rates. If you've been following the charts, you'll notice they're looking suspiciously like they did back in 2008. Remember that time? The housing market crashed, banks failed, and everyone was in a panic. Some experts are even saying that this crisis could be worse than 2008. And don't forget about the carry trade situation. On July 30th, the Bank of Japan nudged their interest rates from nearly zero up to around 0.25%, and the markets definitely felt it. Stocks went down, cryptocurrencies went down. After this, the BOJ said they wouldn't continue raising rates this year, but recently BOJ Governor Kazuo Ueda told Parliament that the central bank is ready to hike borrowing costs further if inflation continues to rise above its 2% target. What Japan needs domestically isn't necessarily what's good for the global economy, and at some point they'll have to make a tough decision. If they keep pushing those rates higher, things could get really ugly. Here's where it gets interesting. Recessions aren't usually officially declared until we're already deep into one. Imagine if an earthquake was only announced after the damage had already been done. That's what it's like when the National Bureau of Economic Research, NBER, the organization responsible for officially declaring when a recession starts and ends, finally makes the announcement. By the time they do, the economy has typically been struggling for quite a while. This is where the SOM rule comes in. It's an important indicator that can give us clues about the recession even before it's officially recognized. Unlike other indicators that come after the recession has started, lagging indicators, or appear before a recession hits, leading indicators, the SOM rule is unique because it can act as both a leading and a coincident indicator. For example, back in 2008, the NBER didn't officially announce the recession until December 2008, even though the recession actually started in December 2007. Meanwhile, the SOM rule had already started flashing warning signs as early as February 2008, indicating that the economy was in trouble long before the official announcement. Now, here's a twist you might not have considered. This year is an election year. No political party wants to be blamed for a recession, so there's a good chance that the powers that be are trying to delay the inevitable, to postpone the announcement of the recession that we're already in, but the signs are becoming too big to ignore. Take the National Restaurant Association's Restaurant Performance Index, RPI, as an example. This index tracks the health of the US restaurant industry, and it's taken a nosedive recently. When you dig into the data, it's clear that restaurant operators aren't feeling optimistic about the next 6 months. It's like when you walk into your favorite restaurant on a Friday night, and it's eerily quiet, you know something's off. So, if your income depends on the public, you're probably already feeling the signs of the recession. And let's not forget about the yield curve, the spread between the 10-year and 3-month Treasury yields. For a while, this yield curve was inverted, which has been one of the most reliable indicators of an upcoming recession. An inverted yield curve means that short-term interest rates are higher than long-term ones, which usually signals that investors are worried about the near future. While the curve is starting to normalize, don't be fooled. It's still one of the best predictors out there, and the warning it gave us should not be ignored. When the curve starts to move back to normal, it often signals that the recession is either here or right around the corner. So, how will this crisis affect people both positively and negatively? Well, in every recession, the dollar gains power because people start to liquidate the things they don't need. Cash becomes king as people demand dollars, which drives up its value. For example, if you own a car, which is not an asset, its value might drop because people are selling off things and assets to hold cash like dollars. This is actually good news for the US, as a stronger dollar helps stabilize the economy. However, it's crucial to be prepared. As prices of assets fall, it might be wise to accumulate cash so you can buy them at lower prices. Stop spending on unnecessary things to be ready for the crisis and to purchase crypto at lower prices. Not financial advice. What you do with your money is entirely up to you. And don't panic when your crypto holdings collapse in price. If you've chosen the right assets, they will come back, because even though asset prices go down initially, they tend to go back up. Here at CryptoVagabonds, we believe in Bitcoin and that it will do well in the recession. Those who are educated in finances can take advantage of the situation, potentially making strategic investments that pay off later. But if you're not aware of what's happening, the crisis could take your business down, cost you your job, and even erode your purchasing power when inflation hits. However, with the right information and strategy, you can turn these challenges into opportunities. Stay informed, keep a close eye on the indicators we talked about, and remember that in the world of crypto, it's all about staying the course and not panicking when the market dips. If you're getting value from this deep dive into how the broader economy affects your crypto holdings, make sure to hit that subscribe button. There's plenty more where this came from, and you don't want to miss out on the insights that could help you navigate these choppy financial waters. All right, that's it for today, folks. Thanks for spending time with me. Keep questioning, keep learning, and I'll catch you in the next video. Stay curious and stay hodling.